All right, well, welcome everybody to our webinar on individual pension plans. Today, we're lucky enough, as people filter in, to be joined by Chris Tomev and Rebecca Neal from TT Actuarial. And individual pension plans is something that's very useful, specific to a certain subset of our clients and friends and people we know. So we thought it would be important to share that with you and and then for anybody watching this after the fact as well. So, Leah, if we can go to the next slide, please, and I'll introduce our team. Okay, so this is some fun stuff to read if you can't sleep, and then just our team, please, Leah. Great. So on our team, we've got 5 people. We've got obviously me, Per Homer. I'm the one talking here. We've got Eric Watchman, and then he's over here. He'll pipe in later with some intelligent questions, I'm sure. And then we've got Leah, who made sure this happened and keeps us organized. Joan and Kashvi. So we've got a great team here, and tons of years of experience and so forth. And I will just go to the next slide where we can introduce Chris. Here's Chris. So speaking today are both Chris and his business partner, Rebecca Neal from TT Actuarial. Chris helps a number of our clients out with their individual pension plans, and what that is, we'll learn in a second. He has a ton of experience. It says he has over 20 years of experience. I'm going to guess that that grows every day. And he joined us. And there's Rebecca as well. And you want to go to Rebecca there, please, Leah? Thank you. And Rebecca has been with TT Actuarial for over 10 years as well. So they're actuaries. It means they're very, very good at math. So, they definitely know what they're talking about. Today, we're going to be talking about individual pension plans, why for the business owner who is over 45, why that's important. If you have a corporation, why this makes, often makes a ton more sense than using RRSPs to save for retirement. Um, one of my colleagues likes to call this the RRSP on steroids. So without further ado, we'll throw it over to Chris and Rebecca. And if anybody has any questions throughout, just pop them in the chat. We'll make sure to answer them or ask them throughout, and we'll get some answers for you. So that'd be great. Thanks, Chris and Rebecca.
Okay, I just want to share the screen here, if I may. Where's my share screen? There we go, down the bottom. Share. I'm going to hit F5. There we go. So I'll turn it over to
Wonderful.
Rebecca. I'll be sort of answering any Q&As as we go along, but Rebecca's going to do the bulk of the presentation today.
Sounds great. Thanks, guys.
And thanks, Chris. Thanks, Per, as well. We're very happy to have the opportunity to speak with you today. We at TT Actuarial, particularly Chris and I, strongly believe in the benefits of individual pension plans in certain circumstances. But we understand they can be perceived as a little complex, so we are hoping to demystify that a little bit for you today. So I'll be walking through these slides, and then Chris will answer questions after. What is an individual pension plan? An individual pension plan, we call them IPP for short. It's a defined benefit pension plan. What that means is that you are funding towards a target specific to you to provide your lifetime pension on retirement with income to a surviving spouse. They're typically registered with the federal government, sometimes also the provincial regulator, depending on the situation. And what an actuary will do for you is they'll prepare your actuarial evaluation every 3 to 4 years. And that determines the contribution amounts that you are allowed to make to the plan. So the actuarial evaluation performed by an actuary will determine your contribution amounts. And next slide, please. Who are individual pension plans for? They're for key executives, business owners, incorporated professionals. They are very popular with high net worth individuals. So in particular, any business owner who's over age 38, has significant and consistent T4 income, and past employment history with the same company is an excellent candidate for this type of plan. How do they work? Your IPP will be registered with the federal government, and then in some cases, the provincial government. Your actuary will prepare your actuarial evaluation every 3 to 4 years. That's to determine the allowable annual contribution limits that you can make to the plan. These contributions are tax deductible. Under these plans, you could retire as late as December 31st of the year you turn 71. And in terms of retirement options, you have the same options as on an RRSP in terms of switching your money into an allowed government account, purchasing an annuity with an insurer. You have an extra option that you can receive a pension directly from your plan. So you continue the plan on and you can draw a pension from that, your own plan. If you choose the other options, you would wind up the plan and move your money out. Now, why is an individual pension plan advantageous? We are looking at this from the perspective of comparing to an RRSP. So in particular, first off, there are increased allowed tax-deferred contributions in comparison to an RRSP. So you're going to have more allowable tax-deferred room. And beyond that, you have the opportunity to make additional tax-deductible contributions in the event of low investment return. That's because under this plan, you are targeting your lifetime retirement income. If your investments do less than expected, you are allowed to put more money in. Not on an RSP, you are not allowed to put more money in if your investments do less than expected. Your allowable contribution amounts will increase as you age, as you get closer to retirement. You are allowed to make a large initial funding amount if you have past service with the same company. So you're kind of bringing that past service into your plan, which is advantageous for the nature of a defined benefit plan. You also have the opportunity to pay expenses of the plan outside the fund, so directly by your company to pay those expenses, and that makes them tax deductible. So that's an extra advantage. You have the ability to self-annuitize your pension inside the plan. So that was, I said, the extra option you have on retirement from an individual pension plan allows you to self-annuitize to keep that plan going and you're drawing down your pension every year. You as the individual in the plan retain ownership of the plan and any surplus that may accrue due to better than expected investment returns. Your pension assets are 100% creditor proof. And even more beyond that, this tool can be very effective for estate planning and succession management. Got an example here, a little illustration. This is based on a business owner who is age 55, who's starting their plan at age 55. They have 10 years past service with the same employer. Their annual T4 income is $200,000. And they have an RSP with accrued investments up to this point of $400,000. So the idea is this person is going to purchase that 10 years of past service into the plan using that RSP money. They can transfer that in. We've got an assumed investment return, which is based off of 60% equities, 40% fixed income. And we're assuming that under this scenario, you the member, would be contributing all allowable contributions that you can. So on the left chart here, RRSP is the red, the individual pension plan is the blue. If you look at retirement age 65, we're looking at 65 and 71. So starting age 55, pulling in those 10 years past service, and you're going to keep contributing until you hit age 65 or 71. And you can see, so the first two columns, retirement age 65, the RRSP is going to give you almost 0.5 million in contribution room, but the IPP is giving you double that. Same under retirement age 71. You can see that red bar is actually less than half. This time the IPP will get you a little more than double the tax deductible contribution room that you have up to retirement. On the right-hand chart, we're looking at the projected investment fund value at that retirement age. So retirement age 65 on the left, retirement age 71 on the right. And looking here, you can see under the RRSP at age 65, we're expecting around 1.2 million. This is based on expected investment return, of course. The individual pension plan is looking more like 1.8 million. And if you look at a retirement age of age 71, the RRSP we're expecting to accrue to around 2.0 million, and the individual pension plan just under 3.5 million. You can see that, in this is kind of an ideal candidate. We're expecting that there's going to be a big advantage to using an individual pension plan over an RRSP. And we at TT Actuarial will be happy to provide a free personalized illustration specific to your data at any time. You can find the information sheet on our website to be completed and sent to our email, which is administration@ttactuarial.ca. And that leads us into questions.
Well, that's great. Can you talk a little bit about, there's a number of questions here I think that we had put together and that other people have, but can you talk a little bit about past service? So in your example, where I think she was 55 and she owned a business, and she'd worked there for 10 years. Can you talk a little bit about past service catch up?
Sure. Basically, what we've assumed here is that this potential member has been committed to tax deferred retirement savings through an RRSP.
Yeah.
So they've used up all their RRSP room. So what CRA will allow us to do we said, well, what if this plan had been set up 10 years ago? So January 1, 2016, when the company incorporated, if the plan had set up at that particular point in time, how much capital does it need in the plan at January 1, 2026? So CRA will say, well, some of that capital has to be through a transfer from the existing RRSPs because they wouldn't have had the RRSP room
Yeah.
in the year 2006. They would have 2016. They would have lost that RRSP room by being virtue in a pension plan. So CRA says we'll allow you to top up the RRSP to the capital that would be required for those 10 years of past service. And if they'd never made an RRSP contribution, they would have lots of RRSP room. The company would be allowed to contribute the full capital of what would have required if the plan had been in place for the 10 years. So you lose your RRSP room going forward because you're in a participating pension plan, and we call that the pension adjustment. And the pension adjustment effectively tells CRA you're in a pension plan and reducing your RRSP room. And what the past service says, well, what would be the PAs that we would have reported for those 10 years? And you would have lost that RRSP room. And they say
Yeah.
that number needs to come in from your RRSP to fund the initial cost and the balance is typically 10 times the annual cost less the PA. That amount is a company contribution. So it gives you a one-time big bang at the setup if you got past service. And certainly if you've got even more past service, 20 years, then you've got even more room that the company can fund.
And that creates, and so just to be clear, not only does that dump in, I guess, we move from the RSP to IPP, it's kind of like for like, so it's not a huge deal, but that extra money that you can put in creates a tax deduction for your corporation for that year, right?
Correct.
Which is really great, and also boosts up that retirement portfolio in the IPP. So that's really helpful.
And it's not a legal commitment.
No.
If you're a business owner operator, the rules changed in 2018. that says you don't have to register these plans in the province of employment. So Ontario, in particular, was one of the last provinces to sort of say, business owner IPPs, we don't want to regulate. So what that means is that it is an opportunity to contribute and not a
Yeah.
legal requirement. And a lot of people miss that subtle piece in the last 6 or so years because they think, oh, once I set up a plan, I've got a liability. I have a legal responsibility to fund it. And you
Yeah.
set up the plan voluntarily, you can terminate it voluntarily, and you can actually voluntarily decide to make a contribution or not make a contribution, which ultimately allows lots of flexibility with business cash flow. It's a down year. Oh, I have to come up with my $50,000 IPP contribution. No, that's not the case. You don't have to. You can carry it forward to a future year. So lots of flexibilities with the ebbs and flows of a business.
It's really great. And what happens? So let's say right now I'm paying myself $100,000 a year, and then for whatever reason my income changes. What happens then?
Well, the 100,000 is T4 income. You do need T4
Yeah, that's
income.
right.
Dividend income can't count. So we are dealing with a T4 of $100,000. And our report, which recommends the contribution that CRA has to approve, says it's this rate of contributions up to a dollar limit. So
Yeah,
you would, based on 100,000, you would multiply it by the percentage that we would make a recommendation on. And that's your contribution, your eligible contribution to contribute. And if your income goes up, then that contribution amount will go up. If your income goes down, your contribution amount goes down. But eventually, once you hit roughly $200,000 of T4 income, that's why we use that in our example, you're effectively capped at a dollar amount. And that's
yeah,
outlined in our report. So just like RRSPs has a rate, and that rate is fixed, 18%, up to a dollar limit, which I think it's something like 30,000 is the dollar limit.
yeah.
That's kind of like how IPPs, except the rate is something like, depending on your age, could be as high as 30% or 40%.
Right. And
And
so
so,
each year you do that calculation on based on. So if I give myself a raise next year, right, because I'm such an awesome employee, then next year I can contribute more, is what you're saying.
correct.
Right?
Yeah,
Yeah. Or if it's a down year and I pay myself less, then I can contribute less.
right.
Okay, perfect. What happens to the plan if I decide to retire earlier than expected or later than expected?
So,
Because usually you set it up with like I think if I recall correctly, when we set it up, we pick a target age, right? Like 65 or 71, right?
it's actually 65 because that's the legislation.
Yeah.
These plans are very, very highly regulated and they've been around for at least 30 years, probably 40 years. And
Hmm.
so they're highly regulated and they dictate a lot of the things that we do for the clients. And age 65 is one of them. So if you retire early or you sell your business early, that's that's fine. You can do that. The plan is either collapsed or an income is paid from the plan, or it becomes an inactive plan. It just stays there dormant as long as the company is continuing in some fashion. It could be
Hmm.
a dormant plan until the end of the year 71. 71 is that magic age, just like RRSPs, where they actually say, you might not be retired, but you do have to start to take money out of that RRSP, out of that IPP, after you've hit 71. So you can continue on in your business and you technically might not be retired, but for purposes of the individual pension plan, you have to start to withdraw after 71.
Okay.
And what do those withdrawals look like there, Chris? Is that, I mean, an RSP will convert to a RIF. In the case of an IPP, for those listening, what does that look like when comes time to convert?
Sure. It's very much a calculation that is done based on the historical employment earnings. And if you understand the Canada Pension Plan, every year you earn something in the Canada Pension Plan, you multiply it by a factor, and that becomes your pension for that year, which is paid out every year after you're 65. So we do a calculation based on the earnings that are made in each year that the plan is in effect, including the 10 years of past service. We index those to age 65. And then we then say that accumulation every year of what you've earned every year based on your earnings is your lifetime pension payable every year while you're alive with continuation to your spouse.
Great.
There is a minimum
Oh,
payout. There is a minimum payout that
mhm.
CRA requires that it's basically you taking the RIF percentage, and if you're familiar with RIF rules, there's a prescribed set of percentages every year from past 71 all the way to 100 as to what percentage of your assets you need to take out. So there is a defined benefit pension based on the historical employment income, and there's also an asset test that sort of says, as a minimum, we want you to take out the RIF percentage.
Okay. What happens if I want to sell my company or if I'm winding up the corporation? What do we do with the IPP then?
Well, it's every situation is unique. Certainly,
Yeah,
on a closure of the company, um, that requires a closure of the pension plan.
yeah.
And you would revert back to your RRSP approach to tax deferred retirement savings if you're less than 71, or
Hmm.
you would or you would transfer into a RIF if you're over 71.
Yeah,
There is a limit on how much you can transfer out of these IPPs. Um, and sometimes that may mean that you're triggering tax quicker than you intended to be paying tax.
yeah,
All this money is tax deferred. So eventually, two things happen for certainty, death and taxes. We just don't know the timing of those two events.
yeah. What about a lira? I've seen cases where somebody sold a company or wound it up, and we roll the IPP into a lira. Is that still the case?
The LIRA concept is still in place
Yeah.
if you're still subject to the Ontario regulators. And
Okay.
that would be in very unique situations um, where you're not a business owner operator, you're in an individual pension plan and you're not a business owner operator. And that means you're still subject to the Ontario requirements, which inherently means a locked-in retirement account or a LIF, life income fund, if
Yeah.
that's the case. I'm 90% of our cases now are
Hmm.
business owner operators where locking in restrictions don't apply anymore.
Oh, perfect. Okay. So you basically, let's say I retire, I sell my business, I hold on to the holding company, the IPP stays within there and it continues, or I have to roll it into an RRSP, one of the two.
Correct.
Okay, well that's great. That's a great change because the Lyra was annoying and handcuffing people for sure.
Okay.
Chris, what about, I mean, for clients that are thinking about this or business owners, can you maybe shed some light on when it would make sense to look at setting up an IPP and maybe when it doesn't make sense? Because I'm sure some people have heard of this, but they might not know when it applies to their situation. Can you maybe shed some light and some guidelines with regards to setting this up?
Well, I'll work through a case that me and Rebecca were working on with a person last week who was
Sure.
age 67 or 8. So they basically only had 4 more years worth of contributions. And on a standalone basis, I would probably say that's kind of maybe not the right spot to be because there is a cost to set it up, a cost to close it if you're closing out the business at age 71. It can make sense in that situation if you have 10 or 15 years of past service and you're 67. Then you've got that bang for your buck for the past service contribution. And you also got about 4 or 5 more years of current contributions based on your employment income till 71. So in that situation, it would make sense. So every case has to be evaluated depending on past service, historical compensation, that sort of stuff, whether it makes sense. When it doesn't make sense is if you're age 25 and you starting a nice startup business. You're probably, because the contributions into individual plans are age related, your age related IPP contribution would mean it would be less than the RRSP. And we've got a quick calculation. It's that sort of cutover where your IPP contribution exceeds your RRSP contributions is about age 38. that's the break-even point. And I think Per introduced it saying age 45. Your typical age 38-year-old in their own business probably would love to be making $500,000 a year, has no debt in the business, no debt personally, and is looking for ways to tax defer money. Then that's the case. But there's not a lot of business owners in the 38-year range when you've got kids, RRSPs, and all kinds of other commitments that you have that much cash flow that you can participate. So while it's the break even is 38, realistically, we start looking at these things for age 45.
Yeah. But if you are 38 and you are in that situation, congratulations. That's awesome. Yeah.
Good. I wish
Yeah.
I wish I knew you earlier.
All right. Yeah. I
Yeah.
wish we knew people like that. Yeah.
Yeah.
Yeah. And so further to Eric's point, so um, setting up an IPP, if you were, we need to hire a company like yourself to help us do it because the amount of paperwork is daunting, right? And for an individual who doesn't do this all day long. That said, my experience in setting it up with you guys is it's fairly straightforward. You want to talk a little bit about how we, how that goes?
Yeah,
So
sure.
basically, my summary is give us some data. I give it to Chris and Rebecca. They put together a proposal, and then you say yes, and they show up with a stack of documents like this for you to sign. That's my short story, but I'm sure there's a more formal way to explain it. Yeah.
Yeah, absolutely. The reality is you've got two professionals. One is the consultant who's introducing the case, which would be you guys. You would collect the initial data. We would run our illustration saying, here's your comparison to the RRSP approach to retirement savings, and here's what it would look like if you set up an individual pension plan. The internal controller or accountant and or external CPA is going to maybe have some input on it. And if the decision is to proceed, then we would ask the client to sign a letter of engagement. And that gives us the sort of here, go ahead and do it. And what we do is we prepare a board of directors resolution to adopt a plan. There is an official plan text that establishes all the contingencies. What if I die? What if I terminate? What if I close out my plan? So that's the plan document. There's a trust agreement we establish where there needs to be 3 trustees. We typically find the members a trustee, their spouse is a trustee, and then there's a third, an independent person, not an owner of the company that is a third trustee. The trustees have no real role per se, other than they have to sign an initial document, a legal requirement for the IPP. But ultimately, the investment decisions become the member or members if there's more than one member in the plan. They have the ultimate decisions on the investments. We have a couple of other government forms, an initial actuarial report, which establishes the rate of funding for 4 years. And we file that application, at which time it's registered. The longest and hardest part is CRA and their queue. So you've got to deal with, potentially 120 to 270 days in their time frame to look at the application, review it, approve it, at which time the money can start to flow.
Yeah,
Annually,
and that's
then we have
important.
to,
The CRA is super slow these
yeah,
days.
yeah, they
And
are. Yeah.
and so it's important that if this is something that we're looking at, we've done some planning where we were on tight deadlines because of business changes, and it's best to try and avoid it. So the sooner we can get this ball rolling, the better it is.
Yeah.
Yeah.
At our end, probably from the point of here's the signed letter of engagement to actually getting you documentation. And we do a lot of this through emails now. It's not in the old days, it was a stack of papers. Now it's
Yeah.
here, sign here. Um, and we're 1 to 2 weeks and tops for that sort of turnaround to get an application prepared and filed with CRA.
Yeah.
Um, yeah, and then annually you have a there are annual reporting requirements. There's annual information returns, there's trust returns. We have to do a calculation to tell you what pension adjustment goes on your T4 so that CRA knows that you're in a pension plan now.
Perfect. I had one other question. I'd heard of, and I haven't experienced this myself yet, but I've heard of opportunities where, some businesses where, mom and dad are running the business, and then little Johnny and Jenny come in graduate university into the similar business and join. Can they join the individual pension plan then too?
Yeah, we're doing a lot of individual plans where the next generation is coming in running the business, and that means, with a T4 income, they can join the plan, and the company can make contributions in respect of their services and employment income.
Yeah. So we would have them join the plan then too. And
Correct.
then if mom and dad pass away and let's say they're all, I don't know, carpenters. Okay. So then Johnny and mom and dad pass away and then Johnny and Jenny are on the plan. If there's money left in the plan, where does that money go? Does it support Johnny and Jenny's retirement then?
Yeah. So you're asking a broader question, if I may, just
Sure.
kind of expand the question a little bit. The money with two people in the plan is portable between one spouse and the other spouse without any tax consequences. With no
Perfect.
future members in the plan and both decease, that money
Yeah.
has to come out and it's taxable in the estate.
Just
We
like an
typically,
RSP. Yeah.
yeah, just like an RRSP. And we
Yeah.
typically want to have people named contingent beneficiaries so that on the second death, the money flows from the pension plan directly to the beneficiaries, the children,
Yeah.
without going through the probate calculation. And that can save you, almost 2% of the assets of the plan, which,
And a lot of time. Yeah.
yeah, so that
Yeah.
that that would make a lot of sense. If they are in the business, then they are drawing T4s, that being the beneficiaries are both beneficiaries of the IPP and beneficiaries because they're running the business. We would want them enrolled in the plan because there is no disposition on the second death out of the plan. The
Yeah.
money stays there for their benefit and tax deferred for their lifetimes and their spouses' lifetimes.
Amazing. Well, that's really great.
And
That's a
then
great opportunity.
Chris,
So work with your kids.
yeah.
Exactly,
Yeah.
if
Yeah.
possible.
Yeah. If
Uh,
you like them. Yeah.
I was just gonna say we have a business owner that is thinking about this, but wanted to run some numbers. What would next steps be? What does that look like for them? And this might make sense. How do we look at this in further detail? Can you outline that for us, please?
Yeah, absolutely, Eric. There is as Rebecca alluded to, on our website, a form, and I can certainly email it to yourselves and or to a prospect saying we need some data. We need to know your date of birth. We need to
Mm,
know your employment history
Mhm.
in terms of income and a little bit on your RRSPs just to make sure that we're capturing all the pieces that if the plan was initiated, we would have a proper thing. The better the data,
right.
the better the output and the decision making is. If you're just trying to get a ballpark number, I can give you that. But the reality is, if you want to really kind of pursue this, you really got to fill in that form and see how the numbers work for you, and not just a ballpark number. But happy to give you a ballpark number as to what it would look like if you completed the form. Better information and better decision making can happen.
Perfect. And then one more for me. In terms of flexibility, I mean, how does the IPP work compared to, say, an RRSP? For example, say you were cash strapped and you needed to access, are there any limits? And what does that look like on that end? Or how can business owners think about the IPP and this overall picture of assets?
Well, it's 100% creditor protected. And certainly, if we're worried about our next paycheck and the income and the business side, an IPP might not be the most flexible tool for you. We would like you to say, if I put the money in, it stays there, and that the withdrawals happen only if I'm have to, age 71, according to CRA's rules. If you wanted to take it out early, there's probably a means to do so, but it's not recommended you withdraw it early. So there is potentially not as much flexibility compared to an RRSP where we basically say, oh, hi, Eric or Para, I need 100 grand out of my RRSP. I'm in bad luck. If that has happened, we can work with it. You can terminate the plan and you can make withdrawals happen that way. But ultimately, the customers that we're dealing with are people that are in solid businesses with positive cash flows. And once the money's there, it's there until 71.
Yeah.
Good to know.
Yeah.
Thank you.
And the IPP gets set up, just for reference, as an account at Asante, typically. It'll look and feel just like your RRSP account. You can invest in it the exact same way. It just has a different name and a different code, but basically it looks and feels like an RSP on your online Asante online uh, access. So just FYI.
Beautiful.
Yeah, great. Well, I didn't really have any more questions. I think that's great, and you guys really answered a lot of the questions that we had a long list there, and you answered them very thoroughly. So we really appreciate it. Um, and Eric, did you have any more questions?
No, that was it for
No?
me. Just wanted to extend a
Okay.
big thank you to Chris and Rebecca for spending the time with us today. And it's very helpful to have experts such as yourselves working in our corner for these unique and specialized products. So very thankful to share that with you. So thank you very much.
Very happy to
Thank,
be here today.
Thanks for the opportunity.
yeah, thanks, Rebecca and Chris. And again, if anyone's interested in learning more about IPPs, very happy to hop on a call with you, and we can pull in Chris or Rebecca and or both, and we can hash out any personal individualized questions you might have. So we're happy to go through that anytime anybody wants. And so thank you, everybody. Hope everybody has a great long weekend coming up, and look forward to talking soon. Thanks, everybody.
Thanks. Bye.
Bye bye.